Become a lender, not a borrower.
Money mindset.
So what is a bond? All it is someone who lends someone else money. So bonds are IOUs. So a person who owes the money is in debt to the other person. They promise to pay that debt back, and they get paid interest called a coupon for taking the risk of lending that money. So two fundamental important metrics are credit quality, so the likelihood someone will pay you back, and the yield, the promised return they will receive. So a bond is where you lend money to countries or companies. So the investor is promised a return. So bond investors are exposed to less risk than share investors because that promise is backed up by legal rights. So the bondholder has that legal right to receive interest, the annual interest, before the equity shareholder receives any dividends. So in a bad year, that bond investor is more likely to receive a payout than the shareholder. Essentially, they're ahead. A bondholder is ahead in the queue than a shareholder because the shareholder owns that, is an owner of that company, whereas the bondholder is just lending money to someone else. So the US government is deemed to be the safest place to lend your money, as they guarantee they will pay it back. If they can't afford to, they will just print more money. So the Federal Exchange will just print more money to pay back any loans they make. So with this guarantee, it comes with a much lower return. So this lower risk means it's going to be a lower return. So riskier lending would be to countries, for instance, Argentina, who has previously defaulted on their debt, so they couldn't afford to pay back their debt. Or Greece, for instance. So during the Euro crisis, they were very close to defaulting on their loans, meaning they couldn't afford to pay back the loans they had made, and the debt was covered by the European Central Bank. So you can also lend money to companies. So this is corporate debt. So the companies use this money to invest in their business, and then they may buy machinery or reinvest that to grow the business. So companies also have different credit ratings depending on the risk of that company going bust and the ability to pay back the original capital or the interest owned. So bonds are the cheapest way for a company to borrow money for that company. So for example, Tesco's, they may want to build a new store to provide milk and bread to more customers. That company has a choice. So they can grow using cash flow from the business, they can sell more shares of their company, or they can sell bonds to pay. So they can borrow money from they can raise using bonds. So Tesco's, for example, is more likely to repay its loan, as it's a large company with large cash flow. It's even in bad times like recession, people still need to buy food there's always going to be a need for this company like Tesco's to buy food. So let's compare that to maybe a small dog grooming company, for instance, who may be already in debt and have to pay high rent payments. So if there's a recession, then they will have to pay back these expenses. So people may cut back on these kind of treats to groom their dogs. So this business is more likely to go out of business than a big store like Tesco's. So you're going to ask for a higher return on the money you lend to cover the risk of not getting that paid back. So just think of it like, imagine two friends who ask you to borrow money from you. So one person has a secure job, maybe has a history of paying back bills, he's paid back before. Then a second person, maybe he's between jobs and you can't remember when he's actually had a job before, and he's got some debt and he's maybe had a history of not paying people back. So it's these two people, they're the first person who's kind of more reliable and who has a job, they're much more likely to pay back the money you lend them compared to someone else who doesn't have a job at the moment and who has a history of not paying debts back in the past. So you're going to ask for a much higher return for the second person who's much more risky than perhaps the first person, because with all investment risk, higher risk means higher high reward. So bonds are part of a massive global financial infrastructure. So there's a source of finances, and the size of the global bond market is $90 trillion. So it's huge. And compare that to the UK annual GDP, which is 1.5 trillion. So the bond market is massive. And there's assessments made by financial analysts, rating agencies are called, examples of these are called Moody, S&P and Fitch. So these companies basically review the financial strength of the company and the government, and they basically give a rating depending on how high the likelihood of paying back those debts would be. And each of these agencies have different rating scales. So you can actually, there's a secondary market as well. There's a primary market as well as a secondary market. So a bond issued can then take that issued bond and sell it in a secondary market. The secondary market is much more liquid and easier to trade. So the bond market can become quite complicated. As we mentioned before, it can be quite a complex character. So we could talk about yield curves, which is analysts in the city can sit around for hours discussing the shape of a yield curve. Or generally, if interest rate is high, then the bond price will be low. In essence, all a bond is lending money and a promise to pay that back after a certain period with a certain reward for taking this risk. So in the next video, we're going to talk about how you can buy bonds and how you can include it in as part of your portfolio.
Money, mindset.